Good morning, everybody. Welcome to the Flow Show. Here we are, Friday, big day today. NFP, ISM, the final data points of the week to see out the week and see if we can make a few more pips just to put in the bank. Good morning, Mr. Keyman. How are you doing today, sir?
Hey, good morning, Ryan. Good morning, everybody. Yeah, as I was saying this morning, I was hoping that somebody would tell me, hey, Kay, it's all right. Don't say good morning. It's already Saturday.
No, I'm lucky. No chance of that, mate. Nose to the grindstone for just a few more hours. Right, let's get stuck into it then, and then we'll take a look at all the NFP stuff. I'm going to have a look at some of the data first. Chinese data, the Caixin Services PMI coming in worse than expected, 50.4, just hovering above that expansion contraction line. Was expected to rise to 51.2. So a bit of a sizable miss there, though it was up on last month. Over in Germany, trade balance data, as you can see there, trade balance looking in the green.
No, Ryan, you're not sure.
Oh, you haven't got my screen up. Oh, why does that not come up? Oh, well, there we go. How's that?
Better. Much better.
Yeah. You got it?
Yeah.
Yeah. Yeah, so there's the, as I was talking about the Chinese number there, a big miss on expectations, still up on last month. And Germany trade balance looking green, okay, surplus, great, but look at the numbers, exports down 2.4%, imports down 1.7%, so still showing lower activity, which is the bad news part of all that data. We've already seen Germany GDP for Q3, a bit better than expected, but still a negative number. No real signs that that's going to improve, at least in the final numbers for that. Coming across to the UK, and we had the final services number, nothing much to speak about there, a slight improvement to 49.5 over the flash number, 49.2. So again, not looking too good over there in the services side, the bigger part of the economy. And as mentioned, we get the US numbers on services later on. We've had ECB's DeCos saying it's too early to speak about cutting interest rates. And this is really going to be the theme, as it has been going into the end of the year, that they're going to be firmly talking against cuts for now. ECB Schnabel says we cannot close the door to further rate hikes, and the euro area economy is not in a deep recession but is stagnating. Right, over to our old mates at the Bank of England. They left the rate unchanged, 5.25 as expected. The vote came as expected, 6-3 in favour of that unchanged number. I thought there might be a little bit of a room for another 5-4 to send a message, but 6-3 it was. So we know that Breeden at least is in the pause camp. The bank said that restrictive policy will be needed for an extended period, and they're watching to see if more rate hikes are needed. The risks to the inflation projections are still skewed to the upside, and only about half of the impact from higher rates has been felt so far. It was a forecast meeting and a presser. GDP, nothing much to write home about. They kept their forecast unchanged for the rest of the year, 0.5%. For 2024, they expect a zero growth from 0.5%, and 2025 was unchanged. They expect a huge 0.2% growth in 2025. CPI data was raised up marginally. Unemployment also raised up marginally for the next couple of years, a pip or two here and there. Wage growth, which they're keeping in the forecasts, probably saw the biggest moves higher. For Q4 2023, they expect 6.75% wage growth. That was versus the prior 6%. By the end of 2024, they expect wage growth 4.25%. That's up from 3.5%, and 2025 was 2.75 from 0.5% previously, so a bit of a move up there in some of the inflationary numbers. BOE's Bailey, I can't tell you too much about him. I was half asleep by the time he'd finished his statement, and the rest of it sounded like the adult in Charlie Brown. All I heard was wah, 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 wah for most of it. But I've picked out some of the comments. He said there was no room for complacency as inflation is still too high, that they will keep rates high enough for long enough to get inflation back to target. Repeated that they will be watching to see if further rate hikes are needed, and it's much too early to consider hikes. The market took this a little bit dovishly, but context as usual. He said we should not keep monetary policy restrictive for excessively long. And repeating what we've been saying as well, that he expects a larger step down in inflation in October. So that was that from Bailey. Kay, did you pick up anything of interest?
Yeah, especially your last words were very interesting to me. That was that. As you said, that was that. I don't see anything really to take away from it. We know how he is. Everything went kind of as expected. Anemic growth. It's I don't know. I'd compare it to a bit what ECB is struggling with, inflation wise and low growth wise. There's not really not much more to take away from it, right?
No, we shall move on then. Get rid of put him in the rearview mirror. BOE's Hauser this morning, was talking about bits and bobs, and he said ending the reserve remuneration would lower interest rates, thus make it harder to bring down inflation. So also speaking about what they may do with the reserves that governments and other people park at the Bank of England, and whether they should pay interest on top of those. So saying that ending that remuneration would lower interest rates. So that's maybe the sort of thinking that's in the minds of the ECB as well, that they don't want to give any form of easing into the market when they're still in the midst of tightening. Right, moving on, just jumping back to some of the data yesterday from the US. We got Challenger layoffs, which came in just under 37,000. That was down from 47,000 the prior month. Not much to write home about there. You can see that number there. So job cuts year on year only up 8.8%. So well down on last year's number. Jobless claims came in thereabouts 217k. This number continues to tick up. The continued claims, which it's been going on for a few weeks now. It's just creeping higher, and that means that people are staying on claims for longer, which is a potential yellow flag, a bit of a warning sign. But we're still talking about fairly low numbers, so it's got a long way to go before we start waving any amber or red flags. But we'll just keep an eye on it as it ticks along.
On those,
factory, go on, mate.
Yeah, on those labor numbers, if you take away like what we are going to get, like the big report for the NFP, and so there's a lot of like very little, but I'm not saying, and as you say, they are not decisive or whatever, but like a bit of contradictory things coming out when we look at certain numbers. Like we see these continuing claims creeping up, but then your other data layoffs are coming down again. But remember, we had big layoffs for a while, right? But there's a lot of little contradictions there, which makes the reading of course, the labor market is still very good, but makes the reading perhaps a little bit more complicated right now, because against those continuing claims, then an hour later or so, you had this productivity number coming out actually better, and there's a lot of little contradictions in the labor market right now.
Yeah, exactly. It's like you look at one thing and you think, oh, that's bad news, and then you look at another thing and you think, well, actually, that's still good news. But
yeah,
I think it's like
Makes
walking
the
on a
reading a little
tightrope.
bit more difficult, right?
Yeah, it's walking a tightrope, and 1 minute that you're wobbling to fall off one side and everything's going to go negative and whatever, and then the economy or the market or sector rights itself and is back on the back walking the tightrope. So yeah, you see these little things. You have to keep an eye on them, because the chart. This is the chart. It says for itself. Yeah, we're creeping up, but we're not. Getting towards the highs that we saw before. We're not getting towards some of the real shit highs over COVID. So we're still at good levels, but if we get a few more weeks down the line and suddenly we're in the 2 millions and then it's 2.5 million, that's when you want to start thinking, hello, something's going on. So it isn't anything at the moment, but trend is your friend, and if it keeps trending, you keep an eye on it. And that's what gives you your potential signals as to when things might turn a bit more sour. Right, for your diaries, Fed's Powell is going to speak at the IMF policy panel next week, November the 9th. So that's one to keep an eye on if he gives any form of update, though after the FOMC, I doubt he's going to give us anything that's off script from what we got from those guys. Coming across to some of the geopolitics, obviously the Middle East still front and centre. It is Friday. We've had 2-3 weeks now of the market taking risk off the table into a weekend, particularly gold. We've seen a bid in gold coming in late, which then dissipates on a Monday when no shit has hit the fan. So potentially that's on the cards again today. Keep an eye on that. The market might become a little bit more numb to it now that it hasn't spread. But what I would say is we've got the leader of Hezbollah, who's got a press conference at 1 p.m. GMT. So it's just in 2 hours, 20 minutes from now. And there's some talk that he might declare official war against Israel, which then brings Lebanon, Iran, and all those people potentially into the conflict, or it could just be a lot of hot air. We don't know, but that's a potential risk news headline bomb coming a bit later today. On the same side, the negative side, there was a story out by the Wall Street Journal yesterday that Russia's Wagner Group, remember those guys, might be providing air defense weapons to Hezbollah. So again, that's a risk headline that just takes things up a notch if it's all confirmed and it happens or whatever. Just bringing everyone else into conflict potentially. But on the flip side, Blinken is speaking to Israel about looking at a pause in their offensive so that people can get out of the country and aid can go in. A temporary pause, not a complete ceasefire. So it's not dialing back hostilities, all that, but it could mean that there is less of a risk this weekend of anything happening from the Israeli side, at least. So, as usual, things to keep an eye on. And as mentioned, we might be seeing risk assets moving later on this afternoon. Right, so Jobs Day, the biggest data point of the month. Let's take a look at numbers and what's expected. It's double bubble with CAD jobs as well. Market's roughly looking at 180 to 190k expectations for that. So your marker. It's market is still coming in around that sub 200 mark, and we've got that gangbusters 336. So maybe the market is leaning a little bit in terms of weaker jobs numbers, but we'll have to see. Are we going to get another stonker, or is it going to be a stinker? That's the fun of this game. We never know. And while I'm on that, I will put up the link in the chat here for our NFP competition. So if you haven't already, don't forget to click on that link, click on that tweet, put your guess on that tweet, and one of three lucky people will win a free month on our chat room and platform. So yeah, 180, 190k expected. Unemployment rate is expected to, where's it gone? Can't even find it. My eyes are deceiving me. There we go. Expected to remain unchanged, 3.8%. As always, we need to look at that participation rate. No big expectations usually for this one. Last was at 62.8%, and just a quick look, we're expecting the same again from that. So as always, you have to judge the unemployment rate in part by the participation rate. More, this number going higher means more people are out of work but now joining the jobs market looking for work, so it can actually mean that the unemployment rate goes up. A perfect number is the unemployment rate down while the participation rate goes up. That means people are coming in to look for a job, but plenty are finding a job. So you always have to take this number in two parts with the participation rate. Then, of course, we've got the wage numbers, which edged back a bit, but are still, sticking around that 4% mark. And the more inflation comes down, the more real wages are going up. So that needs to keep an eye on. We've also got those auto workers strikes, which all look resolved, bar dotting the I's and crossing the T's, which may bring a bit of inflationary pressure to wages, or a bit of upside to wages. Probably not this month, because these deals have only just happened, but it might be something we see in the months ahead. So yeah, really for the jobs number, as long as it's not a minus number, things going to remain positive. But if we get into sub 100k, anything like that, then the market's going to get a little bit wobbly. But anything in or around expectations or higher is going to be brushed over as the jobs market is still strong. If we get another one big number like that last month, then maybe the people are going to get a bit more hawkish about the jobs market, because it would be a sign that the economy is potentially heating up. And if economies heat up, that usually brings inflation. And we might just get the FOMC keeping that hike a bit more closer to their right hand rather than pushing it further away from the table. Kay, you got any thoughts on the NFP today?
Well, basically, we are waiting for that 1 month where the domino is going to start to fall, right?
Yeah, we're getting older and grayer waiting for that to happen.
Sorry, mate?
We're getting older and grayer waiting for that to happen.
Yeah, absolutely. We have been waiting for that for 9 or 10 months now. 1 month it's going to happen, huh? And then there's going to be a lot of "I told you so" going around in the market. But no, we that's what we talk about really very, very often. Is one of the big dominoes that is still standing. And as long as that stands, you can hardly say that things are going worse, because if the job market is doing fine, and I know that people looking at glasses half empty, saying yes, people taking 2 jobs, actually that's not a fair reflection of what's going on. But the market and money creeps where the data tell them to tell it to go. So yeah, anything 100 and above is status quo, and then it's been a lottery the past 6, 7, 8 months, and it's probably going to continue to be a lottery. As you say, I think perhaps the wages have not really been driving a lot, but that could be a bit of a small kicker. And then you can perhaps start to look at the balance between the unemployment rate and the participation rate. Yeah, there's really nothing much more to say about what I think about the numbers. The market, though, seems to be in a mood where it likes to sell dollars again right now, especially since we came back in the yields and went up in the equity markets. A bad number may be the bigger mover, because then those people will start to say, yeah, you see, we're right, and they might be pressing some buttons. If you get a number as expected, then as probably reflection time continues, and let's not forget, and that's exactly what happened on last month's number. If one recalls, a very, very good number is not necessarily bad for equity markets and stuff like silver and things. and recall over the last, I recall it really lively over the last NFP report. That's exactly what happened. We had a what is it, 0.5% rally in the dollar, and then the whole thing reversed because of the equity markets and metals flying. Okay, the weekend after we had that bad news in Israel, but we cannot rule out the same kind of move if we really get a bumper number. But yeah, the state of mind of the market is likely to sell dollar rallies. So it will have to be a really good one to turn the ship around again. But really, I can't only talk about the jobs today, because we've got that ISM services an hour and a half later, and in between we've got the Hezbollah leader speaking. So we may want to be a bit careful when to outright trade the job market, the job numbers as one. I don't think we can take it as one today.
It's a bit unusual having the ISM on a Friday,
yeah, exactly,
after the job. So I know, Ali, you're looking to fade any strong data in the dollar, but you've got to be careful, because we go from one big data point to another, and as Kay mentioned, we got that risk, headline risk in between. So if you get a move, you want to fade it. If you get some profits, then take some off the table. You know the rules.
Absolutely.
Take it off the table and reduce your risk into the next event and see what happens. I think yields are going to be. You've always got to have the yields open these days. We've broken this 470. It's now resistance. This is the signals, clear as you like, what it needs to do. But again, I think it's where we close the week that's going to be important. If we close below 470, it keeps this yield weakness bond rally alive, which then potentially keeps further pressure on the dollar. So I agree with Kay. If there's strong dollar news, that may be worth a fade. You've got to pick your poison as always. Dollar yen, we've had this sharp move off the top. I thought it might have been breaking 150 yesterday. I had a little sell as it started to resist, but that got whipped around pretty quickly. So I'm just keeping my short up above. And I think if we close the week above 150, it'll look more bullish. It potentially means we are looking at another leg higher. We've hit the ceiling here, and this is going to be decisive. Close the week here, then maybe we're going to be heading 152s next. But if we close under it, it might look less constructive, less positive for that to happen. So I think it's take all the data, as I said, everything that's happened this week, take it all, see where you are at the end of the week. Ellie's asking about euro dollar. If we close above the 100 weekly on euro dollar, let's have a look at that. Let's put it on a bit of a clearer chart though, shall we?
Oh, there we go. Wow.
Yeah,
I'm impressed. Such a clean chart.
Yeah, you got to have them clean so you can see the wood for the trees. But got a bit of confluence around here. These weekly MAs, right bang around this, 107 area. So if it closes above there,
I don't
know.
Keep it simple. Keep it at 107 for euro dollar. That's what I would say.
I'll take it as the whole zone. If you want to take it, it's only at 107.10. Take the whole lot. So a close above it today normally it would be when you get a candle like this, that's when you want clarity. So close above it doesn't necessarily mean it's positive. It is a positive step, but you want to if we're above 107.10, right, that's a different kettle of fish altogether. So closing above the EMA, not entirely important in my opinion. Closing above the 107, both MAs, that would be a potentially bullish signal there, Ali. That's how I'd view it. If we don't close above 107 and all this area here, then we're in the range, and you can see how tight this range is and how the market's respecting this range. See how the week closes, because then you know what's going to happen. If you can't break these levels over FOMCs, big data like ISMs and NFPs, then it tells you what the market is happy with where it's at, and it's going to take something big to swing us out those ranges. And then all you have to do is park your bus either end of the range and give it a go there. You don't need to be a hero. You don't need 200 pips stop on it, 30, 40 pips maybe, because it's fairly decent level. That's all you need on it. And if it holds, well, you've got a lot of room to walk around in and to range in that. We should look at gold, obviously, because that's going to be the one that is going to be in a lot of focus later on. Let's go and find it. There we go. Not getting and holding above this 2000 level. So you can see it's running into a bit of trouble up there. We're walking along this line here, this 1986-85 line, which was one I had just marking a bit of a range down to 1885. So we might be looking to bust out of that move. This line's becoming a bit wishy-washy now. But again, where we close above could be significant. If we get another bid into the late Friday, then that's going to tell you that we're back on that bus and the market's still happy to buy this on a Friday and then sell it off to some extent on a Monday. So that might be a little play that if you want the weekend risk on that. But still holding below 2000 now is suggesting that, this rally that we've seen might just be enough for some of the more bigger players to say, no, 2000 is a level, we're not going to let it go through. So that this is going to become your resistance point now. It's building, it's developing. If you want to pick your tops, this is what you want to see: resistance, a break, a hold, lower highs, but we're just not busting down yet. So it's 50-50, a coin toss what it does here. So if you want to short it, you can short around 2000, and you need to stop around above 208, 210, that sort of area. But if you are short, you need it below 1970, 1960. Until that happens, then you've got to be careful. Same with longs. If you're long, you need 1961 to hold 60s, and you need it up through 2000. So a bit of a range to play as well, for both sides.
Yeah, and if one's not in a position right now, wait until the Hezbollah guy talks.
Yeah, I certainly won't be jumping here in the middle.
No.
Get that over with. What else is going on? There's not really. Cables still looking fairly strong. I was hoping we might get a little bit of data yesterday from the US, or a bit dovish from the BOE. Maybe get a look down at 121. That was a bit of a hope trade, if I'm honest. Never even got close. But what dips we have had so far have been bought up. Euro sterling, it's going back to sleep, I think. Again, we're not holding and getting above this 87.20 area, and we can't. We tried getting a hold, we've tried getting above, tried holding it, and we just can't. So it's not quite ready to go yet. But the euro's been fairly bid recently, as you said. But it's going to take a break, I think, Kay, and it's going to take a break of euro dollar. I think
when you go, Ryan, when you go back on the euro sterling, that spike over 87.40 is clearly end of month, and that was like a one-off, it seems. Since then and before, and since we've been struggling up there all the time, and I think that's what it keeps us for one. It keeps us in a range, that is for sure, but it may just signal that 87.40, and we have seen it yesterday again after the Bank of England, is a bit of a bridge too far right now. So it's starting to be interesting, those rejections up there, in my opinion.
Yeah, but you can see we may have just started to step up the range. We had all this range down here. Yeah. Maybe we're looking to step up because we're holding. It's a bit messy, but we're holding above 86, 80s, 90s. So that it gives this move up, this rally, gives it some support here. If we're down under 86, 80, then we're back in this noise. But if we're holding this, then maybe we're going to start challenging up some of these at higher levels, 87s, 88s, that sort of thing. So it's a bit of a coin flip here. Your levels, 87.40 up top, 86.80 down below. Take a move either side of that as your next direction. But yeah, now we've come over all these central banks, this might be going to sleep again. We shall have to wait and see. Kay, you got a couple in particular you want to share the log?
Yeah, I can show just a few and talk quickly about the Canadian jobs.
Oh yeah, we've got CAD jobs. Forgot about that.
Yeah,
so,
but
low Canada up above.
Sorry,
there's the numbers quickly if you want to have a quick look at that.
Yeah,
no, you've taken it off. Why don't you take it? Yeah.
Yeah, I can put them up. I already took the screen, so let me go to that screen. Yeah, so we're expecting the Canadian jobs. So we've heard from McClem already a good few times. He's not turning the boat around yet from hawkish to dovish, but he's come back into the middle, let's say. So this one is going to be a bit of a driver, perhaps a little fresh impetus to what's happening in Canada. We have seen okay employment reports as well out of Canada. So we are going to have a look at what the number is going to do. Then, of course, the balance between the full and the part-time employment change, which is always an interesting one, which gives you, in my opinion, let's say, the longevity of certain move, if the move is continuing or not. That is what this balance is telling you. If the full employment takes everything, that's pretty good for the report. If the report is positive, of course, and then we are going to look at what the employment rate does, which is pretty stable with the participation rate. Okay, so quickly over that, it's usually a decent mover for the Canadian dollar, and we have to put it in the context right now because the Canadian dollar has been on the move of late. Yesterday, big screw back, big recovery of the Canadian dollar in general, despite the lower oils, but then oil has been jumping since. But I think it's a lot of it is euro still giving back through the crosses, and the Canadian dollar being a bit stretched, and positions needing to be cleaned, as we did not make too much more headway in the dollar versus Canadian dollar. Okay, so then back to the screen I was showing again. Unfortunately, perhaps the option market is again not over ecstatic on what's going to happen on the data and on even the geopolitical front. We're still, the overnight straddle here is still only 55 points up and around where we are trading now in the euro dollar, barring the Wednesday into Thursday move. We have to admit that those option market makers have been pretty much right over the past month or so with the pricing of their ranges. So just keep it into account. Again, if we start to get outside, let's say 105.90, and the top side is very close now to 107 here, that's going to, we should see interest on both sides of this spectrum, right? 106 and below, we should find bids based on this, and 107 around, we should find offers based on this, because with people buying those straddles, they will have made their premium back, and we should see some interest up there. So keep an eye on those levels. All right, cable pretty much the same, a little bit more volatile as usual because of the liquidity, but it's still only 60 pips. The dollar yen again as well, little more volatile, but we are only 65 points as well. The Canadian dollar for today could be a double whammy. What are we trading around here? This is actually looking pretty cheap to me, if it's really only 55-60 points. So that means 136.80, 138 the figure. That should find some option interest. Okay, and I'm going to leave it there. Yeah, Ryan was showing the US 10s. This is one that I showed you yesterday as well, and the day before, perhaps when we were breaking. So this to me is the range. Okay, you got the 470 in between, Ryan's 470 in between. Yeah, okay. But then to me, this is going to be decisive for the breaks or holds. And you're talking about 454 to 460, 62. We just went to test it just once already. And on the top side, it's really going to be about this 480 that we broke the other day, and 478 where the trend line comes in. This really 54, 62, 480 on the top side. And if we break back above 480, I think then the bond longs may worry just a little bit. Those who went long bonds on the back of what the one and the other hedge fund was saying, and actually the move that we saw passed after Wednesday, right? So this was a thorough move. If we start to get back above 480, watch out. If we get back below here, if we get down here, that should probably already put a bit of pressure on the dollar, but especially if we start to break at 454, round it down to 450 or so, that's going to be a big level in my opinion. If it goes below there and holds down there, then it's probably the party for the dollar may be over for a while. Right. What else? Yeah, just have a quick look at the Canadian dollar then. So this is one that we were holding this trend line a couple of times, capped here, went through, retested, then retested this one. First little line of alert was the break back below 138 and a quarter. And here, I guess we did a pretty decent round of stop losses once we got below that trend line again and below the 38.2. So that's around 137.70. That's going to be my level of interest today, whether we are above or below on the combination of both jobs reports. We know that sometimes we have a bit of a double whammy or a saloon door on the dollar cat when both job reports come out. So keep an eye on that 137.70 for a starter. I think that's going to be interesting enough. What else? Yeah, yesterday we had a bit of a move here on this Euro Canada, and it starts to feel like a head and shoulder as well. So this is going to be an interesting watch if we start to tackle the lows actually around 145.80, 145.70. Keep a close eye on the Euro Cat. For as long as that holds, then we may actually start to build a range, but it could be that there's a bit of a head and shoulder developing here on the Euro Cat. Watch it for the Canadian jobs report as well, and watch risk for this one too, especially if you start to hear news from that Hezbollah guy and taking oils violently one way or the other. This should have an impact on this one as well. For the rest, oh yeah, it's on the same page. Euros is still hanging. It's trying to perhaps build a little bit of a triangle here. Could start to build a bit of a flag as well. We don't know, but in line with what we've been talking about earlier this week, this one I'm still a bit short of. We had a good test here of this 164.5-ish. Well, a quick test, and then it bounced. It's all within the normality of a move, I'd say. Keep an eye on here. If it starts to go back above 166, then perhaps we need to revise the opinions a little bit. But as long as we're below there, I think we're firmly on the way down. But next Tuesday, if I'm right, we have RBA. So the plan is, if we get another move lower, is to take profits into the RBA and then see what the RBA comes up with. They are expected actually or the possibility is high for them to add another 25 BPs to what they already have. It could cause just a little reaction, and then the market say like, okay, now they are done, and we know what the market does when they judge that a central bank is done. They take yields to the other side, and that may create a move then back up. Okay, we have to talk a little bit about risk because as I'm pleased to say, the market is really suffering from collective Alzheimer again when you talk about risk, and we saw the S&P. I need to show the S&P just before we leave. So this is really a reflection of what's going on here. Stuff like Euromex, when risk is doing better, when the equities are doing better, when yields are coming off at the same time, because the European yields are also coming off. This really has been trading very, very heavy, and we're actually back, just fragile. We're just there, but we're back actually now already into the channel. Keep an eye on 1870 on a close here in the Euromex, okay, today, because that probably will be your guide for what risk could do more. And if risk is doing okay, then I think we may be back into the 1830-40 zone pretty quickly. Yeah, Gavin was saying same thing on the dollar mix as well, but it's going to trade with risk. And if you want to see what positive risk is like in a currency that has no right to strengthen in a normal world, look at what the dollar rand has been doing. We are coming into interesting levels here on the dollar rand, so this one is going to be interesting as well for risk to close the week here. But this one, rand is really been defying the laws of gravity, despite what's happening really on the ground over there. But that's really people forcing out because risk is doing much better than anticipated. So as I said, last one for me, S&P. We are in the zone, 43.10 up to 43.40. Look, no matter what picture you look at, we are there, and this is going to be a big zone to me to close the week. If we manage to get a positive week and we close above, let's say 43.30, 30.50, then we are going to go quickly back into the 44s, I think. But assuming, or not assuming, but let's say that we get like numbers that are too good to be true, perhaps, in the US. Too strong ISM and yields are starting to fly again. This could reverse, or we get really bad news out of the Middle East, and then I think this, despite whatever may happen on the US data, if you really get bad news out of the Middle East, then probably this is going to be a top, and we are going to be looking for lower levels. I'm done, Ryan. Back over to you, mate.
Thank you, mate. Yeah, I just wanted to touch on CAD Yen quickly, just very quickly before we finish it up for the week. Can you see my chart okay?
Yep.
Yeah. Cool. So yeah, Horatio, I don't know what you're looking at. You want to look from the short side. I don't know what your levels you've got going up here. You've got a bit of a zone up here from this, call it 109.50s, whatever you want to call it, up to these recent highs here. So if you're looking at shorts, then these are your levels. There's quite a few levels in here you could look at. So if you're looking to play, I don't know, 0.5% on it or whatever your risk management is, then maybe you can spread it over these levels. Certainly above this 111, this prior high, you're going to be wrong. So if you're not sure where you want to start shorting, you can do a little bit, add a bit, and see how you get on there. Spread that risk in one trade over 3 or 4 different levels. But support wise, if you're short, you got to get through this 107.50s area. First things first. But if you get some shorts on here and you get down to that 107.50, there's some decent profit in the books already, and you look at it that way. But again, look at that risk. CAD jobs, a good strong number might take you up to these highs today. Have to wait and see, and then obviously keep an eye on what's going on the yen side. I think if we've got dollar yen under 150 and you've got a good a good Canadian set of numbers, and this has pushed up on the back of it, then you might have better conviction for a bit of a short if the yen is going to be the most major pair or currency out of the pair. And if that's seeing some strength, broad strength across the boards, and this has gone against it, then that potentially give you a bit of a tailwind for your shorts. But that's my view anyway, and I've knocked that up in the 5 or so minutes that K-Man was talking. So, you know, it's easy to do all these techs. It's how you trade it that matters. Anyway, that's it for this week. Don't forget to have a crack at our NFP competition if you haven't, and you can come and join us on the chat room and see everything we do on this flow show for 40 minutes, day in, day out, every day. Thank you, as always, to K-Man and Steve and the guys behind the scenes for putting this all together. Hope you've had a good week. Don't go doing anything stupid in the rest of the day if you have had a good week. Yeah, have a fine weekend, everybody. Trade safe. We will see you all on Monday.
Have a great weekend, all.